I could make the case that public markets are a little too twitchy, too jumpy, too volatile, and not long-term enough. But I would say the truth is probably somewhere in the middle. And I think where the rubber really meets the road for traditional private equity is what you've seen over the last few years, especially from 2022 and beyond, where exit environments have really, let's say, decelerated, dried up. At different points in time, you become quite dried up. There's kind of that question of, okay, you've been holding this company at a certain valuation on your books. You can still say that you have multiple years time horizon left to hold it. But if you don't have any buyers willing to pay the price that you're holding that company at, is it really actually worth that? Is it worth it 2 years later? Let's go boom.
Hello, everyone. This is Shana Orczyk Sissel, founder and CEO of Boundary and Capital Management, and I am here today with another episode of What's the Alternative? We have a guest today that I have known a very long time, John Lidington, who is a portfolio manager at Man Numeric, and he manages the liquid private equity strategy there. He's been with Man Numeric since 2017 and has led the liquid PE effort there since 2019. Prior to that, John spent the majority of his investment career at Russell Investments, which is how I know him, and then took on operating roles at multiple private companies before joining Numeric. He has a bachelor's degree from Harvard University. Got to make sure I give you full credit for that. And it's great to have you on the show and to kind of dive into private equity, liquid private equity. It's a very timely topic, a lot of product coming to market to help investors access private markets. Very hot topic on CNBC. And so I'd love to kind of hear, how you ended up in this space and your background as it helped prepare you for what you're doing now at Man Numeric.
Sure. Yeah, happy to. I can touch on the liquid private equity concept. Maybe I'll give you a little bit of that, path on the way there. As you mentioned, had worked at Russell Investments for a number of years, really focusing on public equities throughout my time there, which was roughly 8 years or so. When I joined Man Numeric, we were basically just a public equity focused shop, whether that's long short, long only, active extension strategies, but really spent my whole career in equities. Come 2018, we actually launched a strategy here at Numeric that we refer to as liquid private equity. And the idea here was we were going to use public equities, very nuanced set of public equities, to kind of mimic private equity's return profile and do that with very similar return drivers that you have within a traditional private equity portfolio. Very focused on buyout specifically within the private equity landscape. At the time we launched, that was by far the largest segment of private equity, still is the largest now. Given my experience in public equities, I think we can bring a lot of those kind of lessons to life within this mimicking strategy. So I can go into a lot more detail on the genesis of the strategy. The truth is, I actually came in 2019, about a little after a year after we launched the strategy. It was originally conceived by our then director of research, Greg Bond, who had done a lot of work basically thinking about what was it that drove private equity, what was the secret sauce of private equity, and how can we maybe deliver that to investors that either don't have access to the best of the best within traditional private equity, or perhaps they have a different fee sensitivity, they can't pay a full traditional PE fee, or perhaps they have greater liquidity needs and obviously can't be locked up for a number of years and be exposed to kind of the cyclicality and distributions in a traditional PE fund. So knowing that there's a large number of investors who check one of those boxes, if not more than one of those boxes, I think he set about kind of researching what is it that drives PE returns, how many of those characteristics can be found in public equity, public companies as well, and then how can we construct a portfolio very carefully to kind of match that, the risk exposures, the return drivers of PE, and ultimately generate a PE-like return. So it started off as kind of a thought exercise for him, for Greg. And I think step one for Greg was really to go out and research, basically look through a number of academic papers that had focused on this exact question and used an HBS study, for example, as one of the foundations of our liquid private equity strategy. with the key findings that there are a number of very common fundamental characteristics of businesses that are targeted by buyout funds. This specific paper, the HBS one that I referenced, is actually one that went out straight to the GPs themselves, to 85 of the leading GPs. We basically said, how do you guys generate returns? How do you add value? And so straight from the GPs' mouths, they basically filtered down the more common return drivers, and then we set about replicating as many of those as possible in our strategy.
So let's talk about what those drivers you identified were, because when we think about what's going on in markets today, we've had more than a decade where more companies are converting to private than coming to market as IPO. And so it's really changed the dynamic of equity markets in general. And it's also been one of the key drivers to providing access to private markets for retail investors. So when you think about the key drivers of what makes private equity managers, the GPs, successful, what were the key drivers that you guys identified?
Sure. Yeah, there's certainly a number of drivers for the top tier PE managers out there. I think it's going to be a combination of both top down decisions that they make, and then bottom up decisions that they make as well. And what I mean by top down is they're going to do a lot of due diligence on the industries they're investing in, make sure that they're comfortable kind of locking up capital or investing in a company that's in that industry for a number of years. It could be 10 plus years in some cases. So they need to really be attracted to the trends within that industry. And then on the bottom up side, it's basically going out and finding the best companies within an industry that's attractive to them. So there are a number of fundamental characteristics that they're looking for in their businesses. And a lot of those can be fundamental characteristics of the business. So super simple thing to think about when you think about buyouts is they're going to obviously looking for undervalued companies where they can go in, make some improvements, whether it's operational, whether it's financial, engineering, to basically unlock some kind of value that they've identified in that company. So right out of the gate, you're looking for undervalued companies, but clearly because you're going to be loading these companies up with a fairly significant debt burden at the outset of a buyout deal, there's certain fundamental characteristics they need to have to be able to pay down that debt over time, basically what makes them credit worthy. So you're looking for baseline levels of profitability in the business, positive trends as far as the growth of the business, and a number of other fundamental characteristics. And it turns out a lot of those fundamental characteristics are certainly very present in public companies as well.
So in the public markets, I'm assuming, and correct me if I'm wrong, you're probably playing down in market cap, right? Because that's where you're likely to find undervalued companies that have inefficient management, inefficient operations. When I think about buyout and I think about private equity, I remember sitting in a room with Steve Schwartzman a million years ago over at Blackstone, and him talking about one of their key strengths is the ability to take a bunch of companies that they're taking private and create synergies, but also unlock opportunities by being able to manage benefits, manage payroll, and get those costs down because they are consolidating everything under the Blackstone header. And so when you think about that in terms of selecting names, are you looking at, at Ariel, we used to do this intrinsic value exercise where some of the parts, are you looking at some of the parts? Are you looking at, management inefficiencies? How are you able to unlock or identify and unlock value when you're not going in there as an operator?
It's a great question. I think we're not necessarily trying to do that. I think you can look at the operational efficiencies a good management team brings to bear within their companies. PE, if they're doing an effective job managing a company, then obviously there are synergies they're going to realize to your example. But I'd say that there certainly isn't a monopoly on good management teams that exist only in private equity owned companies. There are some very strong management teams at public companies as well. We're looking to identify those. So there is an aspect of our process that is looking at current operational efficiency of these businesses. Again, in the spirit of looking for companies that are efficient enough that they can pay off these debt loads over time. but it is going to be a fundamental difference between this and what traditional private equity does. I would point out, good traditional private equity managers certainly will be able to unlock those operational efficiencies. I'd say there probably are a number of PE firms that aren't as effective when it comes to the operational improvement side of things. So in a way, I don't want to oversimplify it, but in a way, we're trying to actually create more of the beta. Like, what are the underlying return drivers? Kind of looking more at the fundamental characteristics of the businesses, the industries they're investing in, and less about company strategy and active management of that company. That is more PE's domain. I should have given the background right up front. We at Man Numeric are fully quantitative, fully systematic investors. So really, this is identifying the same characteristics that PE cares about, and then putting those into our portfolio.
And as I kind of insinuated, the likelihood that is down cap is higher, correct?
Yes, absolutely. So I think that's actually a key characteristic here. There's certainly some large deals that get done, but those are fairly few and far between when you think about the overall number of deals that are done in any given year. Typically, you're going to be traditional private equity is going to be in a much smaller cap range or smaller company range. I think they do find more hidden gems there where they can unlock more value. So yes, we do the same. We actually try to match the company size. And I think that is actually a differentiator versus some of the other liquid private equity type strategies that are out there in the marketplace. There aren't that many, but some of the ones that are out there are more focused on large cap companies. There's a new one that's been getting some attention in the last couple of weeks, where if you look at their largest holding, I believe it's Microsoft as of right now. You have NVIDIA as one of the top holdings as well. So these are large companies that clearly aren't PE takeout candidates. They far exceed the size of deals getting done in the traditional private equity space. And I'd also say that to the extent that that investors are looking to their traditional private equity as a diversifier to some of these concentrated exposures they're getting in the public equity market today, you're not really diversifying at all if you're just delivering Microsoft in a different package or NVIDIA in a different package. So I'd say getting down in small cap is actually pretty important feature when you're talking about matching the characteristics and the return drivers of private equity. It also, helps check the box of being a better diversifier to some of these concentrated mega cap positions that many investors have in their portfolios today.
As you're talking, I'm kind of thinking, one of the ways that a private equity firm unlocks the value to its LPs is through the exit, whether that be through their company being acquired or through an IPO. So obviously the IPO is not something you think about. These companies are already public. But when you're evaluating opportunities, are you thinking about a potential acquisition? Are you looking at a sum of a parts analysis where what would a buyer out there pay for this company? Are you targeting companies that you think are likely to be acquired as part of your thesis?
So it's not an explicit goal within our model, goal of our process. But it's interesting that over the number of years we've been running the strategy, we've actually had a number of takeouts, and specifically we've had public to private takeouts by PE firms of a number of our names. And I think that's just a natural byproduct of fishing in the right pond. So if you expose yourself to the types of firms that PE finds attractive, I think it's natural that when you have all this dry powder out there in traditional private equity looking for a home, that they're going to eventually find a home for that capital in some of these public companies that we own. It's always nice when that happens. There's typically a takeover premium naturally. So nice little pop typically when those happen. We've certainly had a number of them. So even though it's not an explicit goal of the process, we're not building in kind of a takeover probability type metric. It does happen naturally just by buying the types of companies that the PE firms find attractive and also strategic acquirers find attractive.
Mm-hmm. That I would think would be proof of concept that I'm identifying the right type of companies, right? If the vast majority of the companies that I put in the portfolio eventually end up being acquired or taken private by private equity, then I am very successfully identifying private equity attractive companies. So I would consider that kind of proof of concept that you're doing exactly what you say you're doing. So we've talked a little bit about how you replicate private equity, but I think our audience would really find it beneficial to understand how private equity, and we can talk buyout since that's the most common, typically works. If they're going to take a company private, how does that work? You talked a lot about debt loads. You started working in the strategy in 2019 when interest rates were really low. And so private equity did quite well. But as interest rates rise and the cost of borrowing goes up, it makes returns in private equity a little less attractive. And we've certainly seen private equity has not in any way, shape, or form provided the type of performance most people expect in the last few years. So talk a little bit about what that kind of looks like and why private equity as a whole and trying to replicate that exposure and that diversification benefit is even attractive to the average investor.
Yeah, I'd say probably one of the leading things you're going to hear from traditional private equity managers is just that you're exposing yourself to a much larger percentage, of the whole overall economy. So, overall economy, it's just yes, there's some very large, very visible mega cap type companies that everybody knows, they're household names in the public markets. But at the end of the day, if you look at the overall just number of companies in the country, in the world, the vast majority are going to be private. Doesn't mean they're all investable for a private equity firm, and you're not going to find them all in a PE fund someday. But you are exposing yourself to a number of different companies that you don't get exposure to already. So I think that's probably the number one underlying thesis when PE talks about diversification. Now, you could talk about diversification more from a mathematical or statistical standpoint, and I can poke plenty of holes in diversification benefits of traditional private equity versus public equity. I think a lot of that does come down to the smoothing effect that you get in PE, meaning you don't.
Or I always like to remark that Cliff Asness calls it volatility laundering, but go on.
Yeah, I certainly appreciate. I think that's a great term that he coined. You're getting at the same point there that if you don't have to mark all your portfolio companies on a day-to-day basis, you don't need to mark them to market. Clearly, there's going to be a smoother ride, at least on paper. It doesn't mean your companies aren't exposed to the exact same top-down headwinds and tailwinds that the public companies are, but it does allow you to kind of not experience that day-to-day volatility that you might in the public markets. Now, that's a very attractive feature to some. I would say, and it can look like maybe there's better downside protection when the market does, I was going to say go sideways, but when it really does kind of crash, and the public market will crash, obviously, from time to time, PE is going to look like it's a better downside protector. But I think one of the important points when it comes to downside protection or diversification during those types of markets is that you can actually tap into that diversification benefit when you need it. And obviously, if you're in an illiquid asset class where you can't necessarily tap into those funds at the time the public market might be selling off, like, I guess, what value is that diversification?
I totally agree. And I think it's a good point. The smoothing effect is one that I spend a lot of time on. And I always like to say that I will die on this hill, but private equity and public equity are both equity. And from a diversification benefit, it's really a liquidity conversation. It's not really a diversifier in the sense of how we talk about different kinds of alts. Public equity and private equity are actually highly correlated to each other. Even if you have the smoothing effect, directionally, they are moving in the same direction. And so I think that that's always really important to note. You should be getting some alpha from your illiquidity, and there should be something that you're gaining through the private equity vehicle that you cannot get in the public markets. I've been evaluating a lot of interval funds in this space, whether they be venture capital or private equity. And the one thing I've noticed is, they'll all say, yeah, we mark to market every day, right? But they really don't. They can only reprice the security if there's new information, right? So if it's a private company, you're not getting new information in the regular news cycle. And so, yeah, maybe you are striking a NAV and striking a position like value on a daily basis, but it's probably not changing. So you still get a smoothing effect in many ways. I'm assuming when we look at your portfolio for the index that you help manage, you don't get as much of the smoothing effect. So when you talk about how something like this fits in a portfolio as a way to replicate private equity returns, what does that look like in terms of the experience for the investor?
Yeah, so I'd say you're definitely getting a different set of exposures than you would from just a traditional passive equity, certainly like an S&P 500, or pick any of the very popular kind of passive index tracking ETFs out there. So you're definitely getting a different exposure. You're getting a sector profile, an industry profile that matches that of PE based on actual PE deals being done and basically what you would have in a PE portfolio right now, and those bottom up characteristics. So a lot of those bottom up characteristics are kind of known alpha drivers in the public markets as well. So there's kind of an alpha piece, certainly on a bottom up alpha piece, that's in addition to the value add from sector selection. Ultimately, without the ability to smooth, you are going to get, and this, I'm speaking about the unhedged version. There's the index that you referenced is clearly unhedged, long only. So that you are going to have a bit of equity market volatility that you wouldn't necessarily see in published returns day to day for private equity. I would say that there is a hedged version also available, as you can imagine. Man Group being known for the number of hedge funds we have within the larger firm.
Mm-hmm.
So there is a hedged version available too, if you want to replicate some of that smoothing effect. If it is kind of a loss aversion consideration for individual clients. So that's absolutely something that's available. But yeah, I think at the end of the day, it's going to be tough for any purely public equity mimicking strategy to mimic the full smoothing effect that you get within traditional private equity. And it's kind of an interesting topic that we think a lot about. I mean, at the end of the day, is that smoothing wrong? I think probably not. If you have the appropriate time horizon, if you have a long time horizon and you have a good feeling about what your companies in your portfolio are worth as a traditional private equity investor, and you're not planning to exit in the next 6 months, 9 months, 12 months anyways, you can kind of hang on to these longer term expectations about valuation. And I could make the case that public markets are a little too twitchy, too jumpy, too volatile, and not long term enough. But I would say the truth is probably somewhere in the middle. And I think where the rubber really meets the road for traditional private equity is what you've seen over the last few years, especially from 2022 and beyond, where exit environments have really, let's say, decelerated, dried up. At different points in time, you become quite dried up. There's kind of that question of, okay, you've been holding this company at a certain valuation on your books. You can still say that you have multiple years time horizon left to hold it. But if you don't have any buyers willing to pay the price that you're holding that company at, is it really actually worth that? Is it worth it 2 years later?
Well, we've certainly seen some creative ways to resolve that have come up. I'm trying to remember the term that's used, but there's two things that have been a recent development and to address exactly what you're talking about. The first is, well, we've always had secondaries, but now we have tertiaries, which is, interesting. And then I can't for the life of me remember what they rephrase it, but it's essentially the idea of a private equity firm selling a portfolio company to another private equity firm to put into the next vintage of their fund. So not purely a secondary per se, but like an exit from fund A.
Yep.
And then it becomes a new position in fund B. And the exit is through that. That is another creative way that private equity has found to resolve the exit problem. A tertiary market beyond secondaries. And then this idea of the purchasing portfolio companies and just selling it to the next vintage of the fund so that you have the exit from fund A to be able to put into fund B. And so those are two creative ways that they've dealt with it.
Yeah, so I think continuation vehicles is...
that's what it is, continuation vehicles. I was trying to remember the phrase.
That's definitely been an interesting innovation. And I think...
is it innovation though, or is it just sneaky marketing and sneaky packaging to solve a problem?
Yeah, we'll call it a creative way to generate some kind of distribution to LPs that are hungry for those distributions at this point in the cycle. Yes. I think there's kind of that golden age of private equity probably culminated in 2021 when everything was healthy, fundraising was strong, deals were being done, exits were being realized, cash was being distributed back to investors. And I think 2021 was kind of the peak for that. It's definitely been a lot slower since then. I think LPs are definitely pretty hungry for liquidity, hungry for those distributions. And in some cases, those GPs need to get pretty creative about how to generate them.
Yeah, I would also argue that most companies would prefer to stay private for as long as humanly possible. So they don't necessarily want to exit through the IPO market, which was the traditional way at which a lot of these firms would monetize the positions. Even if you look at venture capital, which is, we tend to think, or I think the audience might think of venture capital and private equity as two different things, but they're not. Venture capital is like a subset of private equity, like buyout is. And even in those cases, we have all these companies coming to market that are providing like a exchange for private companies, right? For individuals to come in and buy private companies and basically a private market exchange. And this is something that's become big because firms are IPOing much later in their maturity. Before companies would come to market as soon as they possibly could, because that was an exit. That's how the founders were able to get compensated. That's how the investors were able to exit and monetize the positions. And so as soon as they were able to fundraise and gain capital through an IPO, they would. Now, it's not that hard to raise billions of dollars from private markets and venture, and firms like Uber and DoorDash. And these are companies that were fully mature when they came into the IPO market and really stayed private for a very long time. So it really has changed the dynamics of private equity and how long the lockups can be. And then again, these creative vehicles of which to move things through the vintage so the lockup periods don't become too extended. But I think that brings us back to kind of the value of something like what you're doing. And I think I want to really hammer this home. You are attempting to replicate some of the characteristics of private equity that are advantageous in alpha producing. But what you're not trying to say is that you are private equity, correct?
Correct. Yep.
Yeah.
Nope. We're definitely not private equity. These are public securities at the end of the day.
Yeah. And I think a lot of people see products out there that are fully liquid and they say private equity in the title, and they immediately are like, oh, I'm going to be able to get all the benefits and characteristics and attributes of private equity for diversification. But in actuality, what you're really trying to do is identify the characteristics that private equity looks for in a company, and then look for those same characteristics in the companies in the public markets and invest in them. And so let's talk about the unique aspects. You talked about how you're quant driven, very data driven. So are there particular factors that you screen for to kind of start your process of finding the names that make the most sense for the portfolio?
Yep, absolutely. So I know I mentioned the top-down aspect before with the industry profile matching, where we're deliberately mimicking the industry profile that you're going to get in a PE fund. So there's probably more of this called secret sauce on the bottom-up side of things. So it's a series of dozens of different models that we employ here that are all targeting some nuance for what private equity investors are looking for in their companies. I know I mentioned a couple of those earlier, just the super easy ones, the valuation characteristics you're looking for, and growth characteristics, profitability, cash efficiency. But some of the more interesting ones are sometimes more related to looking at the kind of ecosystem of interrelated companies that every company has surrounding it, meaning their customers, competitors, partners. Think about that broader supply chain that a company operates within. We as quants can process a vast amount of data on all of these interrelated companies and kind of look for trends that are percolating within a company's broader network, and look for that to kind of identify positive trends that could be impacting a business on a going forward basis. I think in many ways that replicates what a good PE manager should be doing. They should fully understand the supply chain of a company that they're targeting for potential investment. They should understand the competitive ecosystem and basically all these interrelated companies. But there is a limit to what humans can do in a true due diligence on a certain number of companies. They can't go out and assess thousands of different companies. the way a quant can. So we're able to get well beyond first order linkages for companies, go beyond second, third order linkages between companies with this type of model. So that's just one aspect. I know I mentioned there are dozens of underlying models here.
You don't
but
have to give us all the secret sauce,
No.
just a couple of high level things.
Yep. Yeah.
Uh,
So yeah, that's one people tend to find more interesting.
Yeah, so I find that interesting in a lot of ways. You know, we talked about how one of the ways that private equity is able to unlock value often is in the fact that they do take controlling interests. Um, is there ever a situation where you would potentially, obviously, you can't take control in public companies, but you can take an activist stance, right? You can, you know, do something in that vein. And there's a handful of funds out there where the manager may occasionally take an activist position. Is that something that maybe you don't do, but maybe you find yourself in the foxhole with somebody who is taking an activist role?
Yeah, a very good question again. So same thing. Yeah, as quants, we're not going to be the ones playing an activist role. But by nature of what we do, I mean, there are going to be these opportunities in some of our portfolio holdings where an activist will get involved and basically try to unlock change the exact same way. I shouldn't say exactly, but in a very similar way to what PE would do. It could be replacing management. It could be a number of other changes they try to bring about within a company to unlock what they identify as value. Really not too dissimilar to what a good PE manager is going to do. Playbook might be slightly different, but in spirit, there's a lot of commonality there. And like I said, we do find ourselves, we'll call it, you said in the foxhole. Yeah, good. That's appropriate, but basically co-invested with an activist manager that'll come along. And to some extent, that is an alignment again with the broader goal of trying to mimic PE's return drivers.
Would you ever use in your quant models any sort of factor that would follow activist involvement in companies and use that as part of the drivers for security selection?
Yes, that's something we've researched over time. I can tell you there's not, this isn't supposed to be a comment on the broader activist space. There are clearly some very skilled
Mhm.
activists out there, but the data we have doesn't show that doesn't show activist involvement as a clear alpha signal within the public equity market. So it's not something you're going to find a lot of exposure to here, but it's something we've definitely considered and researched over time.
Interesting. I would have thought the opposite, but I guess it's because most people only know like the 3 or 4 activist investors out there that actually are good at being activist
Yeah,
investors.
the ones
Whereas,
who get all the headlines. Yeah.
yeah, exactly. For better or worse. So
Yes.
why
So
don't
there are
you?
some good ones out there. I think of it more as we're going to try to find those companies that are very PE-like,
Mhm.
their characteristics. And if it happens to be that an activist also identifies that company as a potentially a way for them to unlock shareholder value, then great. We're very happy to have them come in and do it. Like I said, there's kind of an alignment of thesis in a way
Yeah,
there.
I was going to say it, in a way, it's kind of a quant and an active manager. I would think you'd find yourself identifying similar companies because you're kind of both looking for the same thing.
Yeah, exactly. It's again, it can be a natural byproduct of the process, just like having these public to private takeouts of names in our portfolio.
Yeah.
It's more byproduct of the process than a clear objective of the process.
Exactly. So, what are some of the ways that you guys think about future trends in private equities? We joke about this all the time. I definitely send you memes from time to time of the Instagram PE guy Johnny, where he has these funny little videos that he creates that are like every PE stereotype, but he often references PE trends, right, in his little skits. And common PE trends that we see today are things like pediatric dental roll-ups, primary care roll-ups where PE comes in, buys a whole bunch. Actually, took my son for Halloween on Friday, and I don't know how I didn't know this, but the dad of the one of the kids' house he was going over, and I used to coach soccer together. And when we were sitting chatting, we were talking about what he does. And I knew he was a dentist. What I didn't know is he does that. And I was like, oh, you're like PE. He's
Right.
like, technically it's just me. So I'm not PE, but it's the same idea. But you see that, you see buying up primary care clinics. And then on a different note, the sports aspect has become really big in PE, and everybody wants a piece of that as well. So when you see these kind of like mega trends within PE, how are you able to kind of identify them and find ways to gain similar exposures inside your index?
Yeah. So we actually have multiple different data providers that we work with who are tracking basically every single deal that's being done in PE, really across the full size spectrum. So obviously, mega deals are going to be captured. That's well known, well publicized. There are a lot of small deals out there done by small funds. We try to really have a comprehensive look at the deal landscape by using multiple data providers, and it's certainly easy. I mean, there are ways to play plenty of healthcare related names within the public equity markets that are actually going to have very similar characteristics, same headwinds, tailwinds to their business and their industries as private equity. Another one that I'm not sure the meme guy has highlighted, but senior living, for example, like are demographic trends really going to impact privately held or PE held senior living facilities or dental, dentistries or anything else? Are they going to impact those differently than one that's publicly held? I would argue no. It's all the same demographic trends. It's all the same kind of thematic tailwinds, headwinds. So it's just by working with multiple data providers. What we do is we use a kind of a rolling time window, so that we're not just keeping this static industry profile for our portfolio. What we're doing basically using a time horizon that kind of aligns with what a PE's investment time horizon would be.
Mhm.
And that definitely changes over time. So you've seen over the years, big increase in the appetite for software companies and specifically SaaS companies within traditional private equity. That type of evolution is absolutely going to be reflected in our portfolio as well. So this is definitely a living, breathing industry profile rather than one that's kind of set it and forget it.
So in that vein, how do you gain exposure to some of that stuff when there might not be a ton of areas in the public markets? And I'm thinking mostly in the sports realm. Like, yes, I know MSG is an example of how you might be able to gain sports exposure through public markets. And there's other smaller kind of publicly traded conglomerates in that sense. But when you think about those trends, something like pediatric dental clinics, granted, there's what 9,000 public companies out there. I'm sure in the small cap industry there might be missing something that's in that area. But does
Yeah.
that really narrow your universe down in many ways when you're trying to get those exposures?
Yeah, there's certainly going to be some exposures that private equity taps into that aren't really available in a perfect apples to apples within the public markets. I mean, I think your sports example is a really good one. Obviously, there's been a move towards ownership of professional sports franchises on the part of PE funds. You can't really say that they're direct public comps. There's certainly kind of an industry that sports franchises would fit under, whether you want to classify it as more like a
Entertainment kind of
yeah, I was
like.
going to say media and entertainment. You can make the case, consumer. There are different ways you can classify these, and there is a little bit of a manual process on our side to map those deals to a public equivalent, in terms of industry. So yes, you're not going to have a perfect apples to apples, but at the end of the day, you're going to have an exposure that's pretty correlated. Let's say it's a media and entertainment asset that is publicly traded. Is it going to be ultimately correlated with a sports franchise? It's going to, in many cases, the answer can be yes. So that's really in the spirit. The spirit is really to try to match as closely as we can, acknowledging that sometimes you're going to have to buy something that's correlated, even though it's not a direct apples to apples comparison.
Yeah, I think that's a good way to kind of frame it. But also might actually make it easier because the number of options is smaller.
No, I was going to say the other thing to point out is just I know obviously taking stakes in professional sports franchises is very popular and headline grabbing these days. But if you look at the overall PE landscape, the money deployed, the capital deployed in these deals is still pretty small fraction. So it's still there's a ton of money going into, obviously, I mentioned the SaaS companies before,
Mhm.
a number of other industries that do have very close public comps.
Yeah, I always say that because obviously you and I bond over our mutual passion for Boston sports teams.
Oh, yeah.
That's how we became friends. That is basically our friendship in a nutshell, was just going and watching Boston sports teams together in Seattle and living the heartbreak and the elation of seeing the Red Sox win the World Series and then watching the Patriots blow their perfect
Uh,
season.
roller
The
coaster.
highs and the lows. But my point being is that, I had the privilege of talking to Mark Lazary about how he goes about managing his sports fund.
Yeah.
And he talks a lot about that the vast majority of the returns you get in sports rights doesn't come from the sexy stuff. It comes from more of the emerging sports and some of the opportunities that are very, very new in their maturity, media rights, all kinds of stuff. So I totally understand what you're saying. I think the concept, though, of being able to match exposures is really important for anybody who's looking to invest in this type of product. Let's just think about from the final standpoint, for a advisor who is considering ways to gain private equity exposure in a client portfolio, what are the key areas to consider where a product that is based off the indice that you manage might be attractive as opposed to the private equity vehicle itself?
I think it's important for any advisor to think about basically all the clients they have in the client base and say, okay, there's certainly going to be a subset of my overall client base who is attracted to the private equity story. Options are now becoming available to actually invest directly in some of these private equity type funds or whichever way you're going to access that, and are okay with illiquidity and okay with paying higher fees and so on. But there probably is going to be a segment of their client base for a lot of advisors that isn't going to be able to check all those boxes. Yes, they may be hearing a lot about traditional private equity. It may sound sexy. They may want to get involved, but maybe they don't have the ability to lock up their capital for years and get exposed to kind of cyclicality and distributions. And ultimately, there are people who are still fee sensitive and they're thinking about how much they're paying. So I think for advisors who kind of have that segment of the client base that ultimately, is going to ask the question of why am I paying so much for private equity? Is it actually outperforming the public markets by a sufficient amount? And if you don't want to be caught flat-footed, I mean, you want to definitely proactively kind of think about, how can I deliver a lot of the benefits, a lot of the things that people like about traditional private equity without necessarily some of those drawbacks that you get in a more traditional, say, drawdown structure within private equity. And I know there's been a lot of product innovation when it comes to some of these semi-liquid vehicles. And you mentioned interval funds before. So there are ways that the industry is innovating now to kind of address some of the historical drawbacks. But I'd say there's still a segment of the market that I would say is going to be attracted to. Basically, you can think of it as like the passive alternative, the passive exposure to the asset class. So in a way, you can think of what we're doing as, I mean, this is overly simplified, but in a way, you can think of it as kind of what is, say, an S&P 500 passive ETF to broader large cap exposure you're trying to get, US large cap exposure you're trying to get in your portfolio. And you don't want to pay a lot for it. You want to be able to transact very easily in it. You want to be able to make tactical calls potentially in that exposure. It's basically, that's the analogy I think about, is this is basically creating that type of vehicle, that passive exposure, the broader traditional private equity asset class and buyout specifically.
Yeah, I think that's a great way to think about it. And you mentioned interval funds, and I mentioned interval funds. Interval funds, um, they solve the problem of the accredited investor qualified purchaser hurdle and the minimum hurdle, but they don't solve the liquidity hurdle. If you are investing in an interval fund, you are locked up. I know everybody will come at me and say, well, no, there are quarterly redemption periods. Yes, but it's never going to be for your total investment.
Yeah.
And there's never a guarantee that you'd be able to get all out in, a single trade. And so you do have to consider these things. Are they more liquid than traditional private equity? Potentially. I mean, secondary markets have gone a long way to be able to offer liquidity if somebody's in distress, but they're still fairly illiquid and you are still somewhat locked up with those vehicles. So important reminder. Thank you for joining us. Is there anything we didn't talk about that you would like to make sure that we cover before we go?
I think we covered a lot of ground here. I actually don't have anything off the top of my head that we left uncovered. I'd just like to thank you for having me on, Shana, and definitely enjoyed the conversation with you.
Absolutely. And, before we go, I would be remiss if I didn't make a sports reference, just because, that's our friendship in a nutshell. How are you liking Vrabel and Drake May? Are you as happy as I am?
It's been a good combination so far. I was actually at the game on Sunday. I was down in Foxborough day before yesterday. Got to see a nice win, pulled it out. Almost looked like we were going to blow it, but hopefully we're a good team that finds a way to win, because for too many years, well, for the last couple of years at least, we weren't finding ways to win close games.
Yeah, I was telling somebody the other day when they hired Gerard Mayo and Mike Vrabel was a free agent at the time, like, what are they doing? And I thought they missed their chance, but thankfully it all worked out and we were able to get our guy. And I just love watching Braves on the sideline. It just makes my heart happy.
It's so much better to be a Patriots fan watching them this year versus the last couple.
Yeah, absolutely. But we are spoiled, and we should probably just acknowledge that. We only had 5 down years. And now it seems like we're on the uptick again. And, there's franchises that have been bad forever, like the Jets. I will never lose a bet to Rob Belkema ever again, because there's no way the Jets would ever do anything that would make me have to wear. Who was it? Whose jersey did he make me wear? So in 2007, I made a bet with one of our former colleagues, and he was a Jets fan, and he made me wear Chad Pennington's jersey to work after I lost the bet, and that was the worst. So
I was going to say Chad Pennington. I thought that's who it was.
Yeah, it definitely was. Well, I appreciate you coming on the podcast. It's nice to have a discussion about kind of what you're working on. I think it's really interesting, and we'll include in the show notes ways in which our advisors and our investors who watch and listen can connect with you to find out more about the index that Man Numeric manages and ways in which they might be able to find an investable fund for those indices. But with that, thank you so much for joining us. Thank you, everybody, for listening. As always, remember to like and subscribe. Leave a comment. Let us know what you want to hear about, who you might want to have on the show. And until next time, this is What's the Alternative? And I am Shana Orczyk Sissel. The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Bonrian Capital Management's platform. As such, Bonrian may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Bonrian Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Bonrian Capital trademarks mentioned are owned by Bonrian Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.